A floating interest rate is an interest rate that changes periodically. The rate of interest moves up and down, or floats, reflecting economic or financial market conditions. Often it moves in tandem with a particular index or benchmark, or with general market conditions. A floating interest rate can also be referred to as an adjustable or variable interest rate because it can vary over the term of a debt obligation. Understanding floating interest rates. A floating interest rate rises or falls with the rest of the market or along with a benchmark interest rate. The underlying benchmark interest rate or index depends on the type of loan or security, but it is often either the London Interbank Offered Rate, LIBOR, the federal funds rate, or the prime rate. When it comes to consumer loans and other debt, banks and financial institutions charge a spread over this benchmark rate, with the spread depending on several factors, such as the type of asset and the consumer's credit rating. Thus, a floating rate might define itself as the LIBOR plus 300 basis points or plus 3%. All sorts of loans and debt instruments carry floating interest rates, but they tend to be especially common with credit cards and mortgages. Types of floating rate products. Home loans that carry floating rates are known as adjustable rate mortgages, ARMs. ARMs have rates that adjust based on a preset margin and a major mortgage index such as LIBOR, the cost of funds index, COFI, or the monthly treasury average, MTA. B-roll change. ARMs are popular among borrowers who expect interest rates to decrease in the future, or who plan to sell their homes before the rate adjusts. However, they can be risky for borrowers who plan to stay in their homes for a longer period of time. B-roll change. One advantage of ARMs is that they often have lower initial interest rates compared to fixed-rate mortgages. This can make them more affordable for borrowers in the early years of their loan. B-roll change. However, it's important for borrowers to understand that the interest rate on an ARM can increase over time. This means that their monthly mortgage payments could also increase. B-roll change. To protect themselves from potential rate increases, borrowers can choose an ARM with a rate cap. A rate cap limits how much the interest rate can increase over the life of the loan. B-roll change. Another option for borrowers is to refinance their ARM into a fixed-rate mortgage if they want more stability in their monthly payments. B-roll change. In conclusion, adjustable rate mortgages can be a good option for certain borrowers, especially those who plan to sell their homes or refinance before the rate adjusts. However, it's important for borrowers to carefully consider their financial situation and future plans before choosing an ARM. A floating interest rate contrasts with a fixed interest rate. With a fixed interest rate, the rate is constant and doesn't change. It might apply to the entire term of the loan or debt obligation, or for just part of it. Residential mortgages can be obtained with either fixed or floating interest rates. With fixed interest rates, the mortgage interest rate is static and cannot change for the duration of the mortgage agreement. With floating or variable interest rates, the mortgage interest rates can change periodically with the market. For example, if someone takes out a fixed-rate mortgage with a 4% interest rate, the individual will pay that rate for the lifetime of the loan, and the payments will be the same throughout the loan term. In contrast, if a borrower takes out a mortgage with a variable rate, it may start with a 4% rate and then adjust, either up or down, changing the monthly payments over the life of the loan.